Hey, it's Richie here. Thanks so much for coming back to the channel. Now in this video I want to talk about whether you can get guaranteed 10% returns in the stock market. No. Thanks so much for watching, guys, and I'll see you in the next video. Alright, I'm just kidding. Okay, let's talk about this idea of getting 10% return on your money in the stock market. We've all seen the memes out there. If you invested £1,000 at 10% when you were 5, by the time you were 12, you could easily have bought your dad's house off him. But funnily enough, when you actually see these memes, you never actually see a source of where you're going to get this magical 10% from. So I sat down to look into this, and today I'm going to share with you what I found. But before I get into it, I need to share with you, I'm not a financial advisor. I'm just sitting here in front of the camera talking about the research I found. So if you find any of this useful, please do me a favor and just drop a like, drop a comment, subscribe. I'm still a very new channel and all that helps tremendously, so thanks a lot. Okay, so the first thing to point out is there's no such thing as an ironclad guaranteed bet your life on it 10% return in the stock market. Just like with all investments, there's at least some sort of risk involved. If you want something that's 100% guaranteed, then you're probably better off just putting it in a savings account or a cash ISA. Investing in stocks is definitely not guaranteed and you don't get the same return every single year. So the only way to kind of make this work is if you look at things over a longer period of time and look at the average rate of return over several years as opposed to this is what I'm going to get every single year. So there's many ways to invest in the stock market, but the two probably the most common ones are picking stocks or investing in index funds. If you're not familiar with the term index funds, it's essentially an easy way to buy a basket of stocks and essentially own a small portion of everything in it. Now picking stocks on the other hand is essentially exactly how it sounds, so you're just choosing individual companies to buy. Now the average investor doesn't beat the returns of index funds, and as much as we like to all think that we're above average, the data is not really on our side. So much so that Warren Buffett, who you might know as one of the richest men in the world, who actually got there by buying individual stocks or buying large portion of companies, he's actually set up his estate so that 90% of his money when he dies is invested into index funds. So even though he made majority of his money investing in individual stocks, he knows that that's not something that the average person can do, and that's why he set it up that way. However, when he dies, he set it up so that 90% of his estate is invested into index funds, specifically the S&P 500. Now he's obviously done this because he knows that picking individual stocks that end up winning is notoriously difficult and the average person probably can't do it. So what's the average rate of the S&P 500? Let's go look into that now. So according to Business Insider, the annual S&P 500 rate of return for 2019 and 2020 was 31.5% and 18.4% respectively, which is incredible, but that's a massive difference in comparison to 2018 where it actually lost money. This is why it's so important to not look at it year by year and look at the average rate of investment over a long period of time. Ideally 10 years or even more, because that's a reliable time frame to work with. Now, if you're wanting to put the money in for a year or less, that's not really investing, that's more trading, and who knows what can happen in that time. By the way, it's worth pointing out what happened in the past doesn't guarantee what's going to happen in the future, but we can use it as a guide to educate us on what is possible. Now you might be wondering, isn't the S&P the American stock market? Why are you talking about that when you live in the UK? Where's your loyalty? Well, here's the thing. Right now I'm shooting this video using a microphone, ring light and tripod that I bought on Amazon while doing research on Google on my Apple MacBook. So whether we want to admit it or not, some of the biggest companies and a lot of the innovation happens over in the US. In fact, if you look at the top 10 companies ranked by market cap, 7 out of 10 of them are actually American. At the time of making this, the highest ranking British company is number 68, and who knows why that's so popular. So that's great to know, but how does that relate to real world returns? Now, I've been looking at different websites to see the average rate of return from the FTSE and the S&P. Now, a lot of websites had different numbers, 1% here or there. So what I decided to do was compare real world funds that you can invest in today and see how they performed. So I've pulled up VUSA, which tracks the S&P 500, and VOOC, that tracks the FTSE 100. I don't know if that's how you're supposed to pronounce them, but I've put the spelling on the screen so you can find them yourself. Vanguard have also got a fund that tracks the FTSE 250, which is probably a fairer comparison to the S&P 500, but there just wasn't enough data, but I'll throw the stats on the screen so you can compare that as well, just for fun. So as you can see on the screen, if you invested £10,000 in VOOC in May 2012, it would be worth £18,500 by July 2021, Alternatively, £10,000 into Vusa in the same month would be worth £39,000 in July 21. So that's a massive difference. Also, you can see here on Morningstar that the 10-year average rate of return on the FTSE, which is the UK stock market, has been 6.6%. Meanwhile, Yahoo Finance is showing the S&P 500 having a 14.71% return over the past 10 years, which is a massive bloody difference. Now, every 10-year rate of return is not going to be 14 point something percent. So I'm going to throw up some numbers on the screen now so you can see how it's performed in the past. Now, this is not to say that America is the be-all and end-all of investing, but I'm just trying to prove a point that to get better returns, you have to sometimes think a bit more globally than just relying on the UK or wherever you live. I'm personally allocating a good amount of my portfolio in the S&P, and I'm doing this using Freetrade. And if you're interested and want to sign up, please use my link in the description below. And once you fund your account, we both get a free share worth up to £200. And you don't actually get this if you just go to their website and sign up. So if you want the free share, please use my link in the description below. And as a thank you, anyone who signed up with my link, I'm actually giving them access to this net worth tracking dashboard that I created. So once you've done it, just shoot me a message and I'll get it over to you. By the way, one of my favorite investing quotes is, it's about time in the market, not timing the market. So the sooner that you get into the market to invest in the long term, the better it is for you. So do your future self a favor and just start as soon as possible. And if you made it this far in this video, please do me a favor and let me know in the comments. I always wonder if anybody even gets this far, or I'm just talking to myself at this point. And if you're still here, please hit the like and subscribe button too, because as I mentioned before, this is a pretty new channel and I'm trying to get monetized. So every little helps. So please do me a favor and click all those. And thanks so much for watching, and I'll see you in the next video.